We are going to start today's session with a conversation with Pawel Maj from Warsaw Equity Group. Pawel, welcome to the show.
Hello, Ramana. Hello, everyone. Thank you for the invitation and welcome as well.
So, Pawel, tell us about what's up in Poland. You are in semi-war zone. So how are things going, and what's the atmosphere like, and what's happening with the startup ecosystem?
Well, on one hand, luckily, we don't see any war zone by ourselves. The war is in Ukraine, which is our neighbor country. Although we see the effects, we had just a huge wave of immigrants coming from the Ukraine to Poland, especially women and children. They were fleeing for their safety. We already admitted almost 5 million immigrants just in the period of just few weeks. So it was crazy actually, and the involvement of the Polish population, bringing everyone to under their roofs, welcoming and helping them out. It was just incredible. So in just difficult times, it was very great to see the Polish population, Polish community coming together and helping our neighbors. So
that's really heartwarming to see how well the Polish people have welcomed the Ukrainians.
Well, but you know, probably Ukrainians are our brothers, they are our neighbors, but also we share the same history and we have the same worry regarding the safety. Also, look at our shared history with the Russia, also as our neighbor. Yeah. So you know that there's a big, actually very.
There's a lot of empathy in the population for their situation.
Yeah, exactly.
Yeah. So let's talk about the startup situation and talk about Warsaw Equity Group, your fund. What are the particulars of the fund? We're going to get into those details.
Okay, so I guess I should start with a short pitch, a short introduction of the fund first. So my name is Pawel Maj. I'm investment director of Warsaw Equity Group. My fund, we are a family office with headquarters in Warsaw, as the name implies. However, we invest in the whole region, Central and Eastern Europe. We are a family office. We have $150 million under management. And our focus are B2B startups, hardware and software, especially in automation and process improvements that are headquartered, that are located in Central and Eastern Europe. Our investment ticket, since we are a family office, but we are a multi-stage fund, we invest in private equity like deals, we invest in venture capital type deals, and also we are LP, we invest in pre-seed and seed funds as the investor.
But you invest directly into companies?
So we invest directly into the companies, but also we invest indirectly, becoming investor at early stage.
I got it that you're a fund of funds and you invest in funds, but yes. You know, for the interest of this conversation, we are mainly interested in your direct investment activities.
Okay. So we invest directly. Also, our main direct activities regard venture capital. We do late seed and Series A investments directly into the startups.
So let's talk about what kind of ticket size do you write when you do a seed investment or a Series A investment? What is your preferred ticket size?
Our initial investment is between $1 to $5 million, and we are able to invest additional up to $5 million in the follow-on rounds. So in total, including the first investments and the follow-ons, we are able to invest up to $10 million per project, per startup.
Okay. So B2B, 1 to 5 million, and with follow-on another 5 potentially. Now, exactly. What do you want to see in a company that would give you comfort to write a $1 million or upward of $1 million check? What proof points do you need to see?
Mm-hmm. We are a later stage investor. So first of all, we expect that the companies are already at a post-product and post-revenue stage. So we expect to see already a product, even if it's a service or if it's a physical product or or a SaaS solution, we expect to be commercial ready. We expect to have the first revenues. We focus on startups that have at least $50,000 MRR, or in case of hardware, at least $50,000 first margin monthly. We expect to have already, there's already like a complete core team. And we also expect the project, we like to see the project to be working, even if it's a niche, but the niche that we're able to grow the project at least 10, 20 times fold since our investment.
And so there's an interesting subtlety in post-revenue investment that I want to probe with you. So in a sense, the stage that you're talking about is probably a termed post-seed, pre-Series A, all the way to Series A, right? Yep. So now you want to see revenue, great. There are a few things that are in the pre-Series A, post-seed, pre-Series A stage that happens that I want to get your input on. So, you know, the notion of repeatability, the notion of velocity. Companies do really well if they find the go-to-market strategy, the unit economics and everything that gives them velocity, that gives them a lot of repeatability. If it's an enterprise customer, if they're selling to enterprises, they want to figure out how to repeatably sell to lots of customers quickly, you know, with reasonable sales cycles. Am I reading you right in saying that these are things that you're okay with not being fully fleshed out and can be fleshed out after your investment comes in?
To some extent, yes. I mean, we like to see the first traction regarding repeatable sales. So we are looking already at the product market fit. We're already looking for, we like to see the companies that they already figured out a repeatable way to sell the product. It doesn't have to be to enterprises, it can be to SMBs. But we are as later stage investor, we are more keen to provide capital to scale what's already working than provide capital for seeking to see what sticks. And in our case, it comes from our approach that we would like to have about 10, 15 companies in our portfolio at any given moment, provide them even a larger amount of capital, but also being able to focus, to work with them, being much more hands-on, since our heritage comes from private equity market. This is from where we come from, and now we are investing at early stages. So the strategy that works at seed investments, pre-seed or seed, usually invest smaller tickets, but with much larger amount of projects to spread the risk among your portfolio. In our case, we don't have a large enough team to have a large operational focus to be able to provide hands-on experience for 50 companies, let's say, in our portfolio. This is why we prefer to invest at later stage after product market fit to be able to work very closely hands-on with the portfolio companies. So this is why we do this.
So the reason I'm kind of probing this point, and for those of you who are listening to this conversation, please note, there are a bunch of things that happen between, you know, pre-seed, seed, pre-series A, series A in this continuum. You have to achieve product market fit, which means you have to get some customers to say that, yes, I want this product and that I'm willing to write checks. Then you have to figure out a repeatable way of doing that over and over and over again, right? So it's not one company, one customer buying your product. You have to get numerous customers buying your product. So 50,000 ARR, depending on what is your average sale price or average, deal size. It's still a small number of customers, most likely, unless you're selling a $5 per customer kind of product.
Yeah.
Yes. But then if you want to go
also what's very important.
Let me finish just 1 second, Pawel. Let me set the framework, and I'll come back to you. So then, go from 5 customers to 50 customers to 500 customers to 5,000 customers. This is the continuum that you're trying to travel in building a significant company, and that is where you are in that continuum. In the 50,000 ARR, maybe, MRR, maybe you are in the 5 to 50 customer range, but you may not have fully figured out the full spectrum of how you're going to go from 50 customers to 500 customers or 500 customers to 5,000 customers. These are the nuances of questions that you should be asking the investors that are looking at your company to evaluate your company on where is their comfort zone. This is the notion of investor-entrepreneur fit that you've heard me talk about ad nauseum. You know, investors will invest in their comfort zone, not in your comfort zone. Investors have their own comfort zones, just like Pawel is explaining that there is a certain sweet spot in which Warsaw Equity Group likes to invest. There's a certain geographical sweet spot, there's a certain stage sweet spot, there's a certain industry sector sweet spot. It's B2B SaaS in Eastern Europe and Central Europe, and in this kind of post-seed pre-series A sweet spot. This is what I'm hearing from Pawel. So,
yes.
So coming back, Pawel, can we do some examples, some case studies of companies that you have invested in, and tell us not only about what those companies are, what they do, also when did they come to you, what did they show you that caught your attention, that captured your imagination enough to want to write these checks?
Mm-hmm. So before I start, I will have to say that our portfolio right now is very diversified, since it comes from our history. As I told you, we started as a private equity fund. We're doing more like buyout deals, greenfield investments, also working with very traditional sectors. Since the last 2 years, we are rebuilding our portfolio, changing our strategy to invest more into tech startups, more like investor capital deals at early stages, smaller tickets, early stages. Actually, myself, I joined the fund this year to execute the strategy. So there was a lot of changes, but we found a model that we like to execute and continue for the years to come. And in our strategy, we like to invest at least $50 million in the next 2 to 3 years, mostly focusing on venture capital.
You don't have a portfolio yet on this investment thesis that we just discussed.
Well, we do, but we just started executing the strategy. So, for example, this year we already went through two investments. We conducted investments.
So let's talk
right now
about
we are
those.
closing 2 additional.
That's what I want to talk about.
Okay.
Is the companies that you have invested in, that you have gone through this cycle of evaluating and investing in. So tell me about what those companies are and what did you see when they came to you? How did they come to you? What did you see when they came to you?
Okay, perfect. So probably a great example of our strategy and our approach. It's an investment that we conducted in March of this year. It's a Polish company, which name is Nethaza. They provide merchants that sell on Amazon a software to automate their tasks, how to onboard to Amazon platform, and how to do all the selling processes on Amazon, how to automate them.
Amazon sellers. The target market is Amazon sellers.
Yeah.
Yeah.
Yes, exactly. Already on Amazon platform, we like to automate the task, or maybe new merchants are just coming to Amazon platform and are seeking for a task solution that will help them out with these processes, especially where they have high volume on the Amazon platform. So we decided to invest in the company when already they had traction, so they were post-product, post-revenue, hitting over this $50,000 MRR target. Wow. So for us, it's very important criteria for the selection. As you told our viewers, each investor has its sweet spot. In our case, the the segment, the industry, the business model, and the traction are key elements to decide which startup already meets our investment criteria.
Yeah.
If we have startup that meets most of the criteria, but for example has smaller traction, we like to keep in touch. We build a relationship, but we postpone the investment decision until the KPI is the traction regarding the MRR.
This is an important point to note for people who are listening, is that sometimes when you're in the fundraising cycle, you may not be quite ready for the investor to write the check, but you build the relationship, you're showing traction, then you keep in touch. It's like, okay, this month we have crossed this MRR, and then this month we've crossed the next MRR milestone, and at some point it will converge potentially if you know what your target is, right? In this case, Pawel is explaining that the target is $50,000 MRR. So if you start the relationship when you're at the $10,000 MRR point, you kind of have to inch your way up to $50,000 MRR, and then perhaps the investment is going to happen. But that investor relationship management is important. If you have otherwise a good fit, if the market is of interest and the team is of interest, then sometimes investors just take a little bit of time to see how you're performing to get to their comfort zone. That is the notion of investor-entrepreneur fit.
Exactly, and something that I would like to add up and maybe to suggest your listeners, often there is, even though there is a fit, that there is no enough traction, that's a sweet spot for the investor. As you said, it's a matter of entrepreneur-investor relationship. Something that I don't see very often, I would like to see much more often, it's the founders, the startups that are during the fundraising mode, prepare and execute like a investor newsletter. So they prepare like a newsletter, and they keep sending the updates, let's say quarterly or every month, every quarter, every half a year, if given potential investor agrees upon receiving such correspondence. And then it's a great way, to keep in touch, remember about yourself. And once you keep the metrics, the KPIs that are in the sweet spot of the investor, the investor will come back by themselves and say, okay, thank you for this update, for this newsletter. For us, it's the right moment to come back to the discussion regarding the investment, and then you change the dynamic, yes, and the investor, doesn't forget about you, and then he or she has the opportunity to come back to the table when there is a right moment.
Definitely, and I think that in that process of covering that ground from, if you are below the threshold where the investor and entrepreneur comfort zone is, try to also develop the strategy and develop that repeatability notion. The whole game in B2B SaaS, the whole game is repeatability of customer acquisition at a reasonable unit economics. So there are a number of factors that you have to take into account to pass due diligence, and those are repeatability, those are unit economics, those are, reasonable customer acquisition costs, and so forth. So let's actually talk, Pawel, also about what's happening in the region in Eastern and Central Europe where you are working. What kind of deal flow are you seeing in B2B SaaS? Is B2B SaaS really active? What's happening? How many companies in the zone that you're interested in, how many B2B SaaS companies are there?
Well, it's a great question. We don't have like any centralized database, but I would say that we have probably between 5,000 to 10,000 startups in B2B SaaS in Central and Eastern Europe. It's just my private guess, since there is no official data. B2B SaaS dominates the venture capital deal flow. This is where most of the investments happen, actually. And this is the business that's the easiest to scale internationally, also outside the region, because the investor, even the local investors or the regional investors, on the one hand, they have smaller tickets, so it's much more difficult to scale hardware business. It's much more difficult to scale platforms or marketplaces. So B2B SaaS, especially for the early stage investors, are the most preferred investment types that they like to consider and like to invest.
And how are you viewing exit strategy in your investment thesis for the funds vis-a-vis these B2B SaaS companies? What are you thinking? Are you thinking that you're going to build unicorns from the region, or are you thinking of looking for, earlier exits? What kind of, investment thesis are you working on the basis of?
In case of Warsaw Equity Group, actually, we are not in the game of chasing unicorns. We look at reasonable returns. So actually, we are looking at startups that we believe can increase the value of our investment tenfold or more, but it doesn't have to be unicorn. So we believe that as we look at the market and the competitors, our colleagues from venture capital, private equity, we see that too often chasing unicorns means too much capital, chasing the increased revenues at metrics that do not make sense, actually, too high burn, etc. So actually, we are more keen to look at very healthy businesses which have B2B, let's say, SaaS businesses that have great metrics. And for us, they do not have to have the ambition to become unicorns. For us, it's good enough, if they have the ambition to grow, let's say, maintain their 100% growth year over year for the next 5 or 10 years. And if it means that they will not become unicorns, but they will, let's say, tenfold their evaluation and tenfold their business size, for us, it's good enough, actually. This is the kind of businesses and the founders that we are looking for.
Mm-hmm. We are very big fans of capital efficient businesses that are not necessarily chasing unicorns. And partly the problem I have with this unicorn chasing, mindless unicorn chasing, is flushing these companies with too much capital. And then the exit bar is so high that, companies basically end up in this twilight zone where they are burning too much cash and can't raise more money and can't find an exit because the valuation requirements are too high to have a profitable exit, etc. So I'm actually pleased to hear that you are thinking, that you're acknowledging that there are other ways of building businesses. Now, there is a question, though, how much exit capacity exists in the region for, if there are 5,000-10,000 startups and most of them are going to seek exits, how do you think this is going to play out? Uh-oh, did we lose the audio? So folks, the reason I will let Pawel figure out how to, you're back.
Well, it's a great question. It's a great question. In our case, we see at least 3 pathways for the exit. On one hand, our focus when we invest in startups, we seek the startups that actually already are doing business, at least in the region, or maybe are selling the products to more international base of their clients, of customers. So the focus is not solely on local market, let's say Poland, Bulgaria, Romania, not even Central and Eastern Europe. We are seeking startups from this region, but the ideal startup from our perspective is a startup that already has very broad customer base and already they've proven that they can sell also outside the region, let's say Western Europe, the North America, maybe the Australia, etc. So the more sales they bring from outside the region of the Central Eastern Europe, the higher probability of the exit also among the strategic investors that are outside the Central Eastern Europe. So this increases the probability of the exit to a much larger international global corporation. So it's also very important when you mention the sales and the metrics for the B2B SaaS. It's also very important where do you generate your sales, geographically speaking? Do you generate your sales only in one country or region? If it's the States, okay, it's good enough. But if you generate the sales on a very small local market, there's also always the question of the investor. What happens when you reach the full capacity of this local market? Will be able to go outside this local market to further expand your startup? In our case, the ideal scenario is the startup that already maybe doesn't have huge MRR, maybe it is only $50,000, let's say MRR, but already among a broad scope of customers from different geographical regions. And then the probability of the exit among corporations from outside the region are much more higher.
So we have worked a lot with this model with the Indian startups. The Indian market is full of B2B SaaS startups now. And one of the things that the Indian investors have learned is that it's actually great to validate the market of business, validate the customers in the Indian market or in the Asian market, and then very quickly they come to North America and then chase the global market. This is, it's a tried and true formula. They're using it constantly and building very good companies based on this formula. There is, nonetheless, I think you can imagine just in Central Europe and Eastern Europe, you have 5,000 to 10,000 B2B SaaS startups. India probably alone has, that many and many more. So the volume of B2B startups right now, SaaS startups, is very, very large. So the number of companies that are going to be trying to do this is very, very large. So one thing I would like to point out is that I think as this market matures, there are going to be private equity-led roll-ups. And some of the exit is going to be not into the strategics, but into these private equity roll-ups. And if you talked about Amazon sellers, that's a market where this is already happening. There are private equity roll-ups happening of Amazon brands that are getting some traction, and then some private equity company comes in, or they create an umbrella brand, and under which they roll up a whole bunch of good brands that are scaling nicely. So I suspect that this is going to, I don't suspect, I predict this is going to happen in the B2B SaaS world as well. Do you agree?
Yes, of course. We are we don't see it much in Central and Eastern Europe yet. We see it in the more developed countries, Western Europe, the States. Yeah, we also see that more and more often. Larger startups, they buy out the smaller startups as well, to speed up the scale of the
strategic exit. Yes, the largest, actually larger startups buying out, not just public companies buying out smaller startups, but larger startups buying out smaller startups is happening.
Exactly.
Especially the ones that are doing this unicorn route and they're flush with capital and are not showing enough revenues, are a great exit target for the smaller startups that are capital efficient and are showing good momentum. Yes, absolutely. So very good. All right. Well, Pawel, I hear that you're going to stay on for the pitches. Yes.
Yes.
Okay.
Yes, of course.